Okay, let's keep going with questions related to understanding the basics of job order costing. We're going to get into some calculations in this video, and we're going to start right here. It says, trust company applies overhead based on direct labor hours. Okay, so that's very, very important information. We're probably going to want to underline that. The beginning of the year. This is also important information because it is at the beginning of the year we're going to estimate our total amount of factory overhead. Machine hours are estimated to be 200,000 hours, and direct labor hours are estimated to be 35,000 hours. During February, Trust has 5,000 labor hours and 10,000 machine hours. The question is, what is the predetermined overhead rate? So, it's very, very important here to understand that the only thing they are asking of us for is the predetermined overhead rate. There are many distractors in this question. Number one, we've already established that we're going to apply overhead based on direct labor hours. Therefore, this 200,000 hours here is not necessary. We don't need this information. We do, however, need this information because we're estimating that there are going to be 35,000 direct labor hours for the year. During February, this information here for this question is irrelevant. We don't need to know how many direct labor hours. We're never going to need to know how many machine hours they had. But this 5,000 direct labor hours would be relevant only if we were asked to apply overhead. And we're going to get to a question with that. But for now, all we have to know is the predetermined rate. So we're going to take the estimated annual overhead, and this is always, always, always going to be numerator. We are going to divide that by our activity level of 35,000 direct labor hours. Now, let's see here. I have goofed up. Let's see, where's my calculator? Here we go. Let's see, let's straighten this paper a little bit while we're at it. So $700,000 of estimated overhead for the year divided by 35,000 hours, direct labor hours, is 20. Move this out of the way. And that's going to match up to answer choice C. Okay? All right, so next question says that some company uses a predetermined rate to apply overhead. No kidding. At the beginning of the year, Carlson estimated its overhead costs at $204,000. So, let's see here. What do they want to know? If the predetermined overhead rate is based on machine hours, what is the total amount applied to plant-wide overhead account? To the plant-wide overhead account for the year for the company. All right, so they have not told us what the predetermined overhead rate is. So as soon as we see this, estimated its overhead costs at $240,000, first thing we need to be doing is plotting that estimate of overhead as our numerator. So direct labor hours they've estimated at 40,000 and machine hours at 10,000. Okay, and we see down here that the predetermined overhead rate is based on machine hours. So in this question, we don't care about direct labor hours, we care about machine hours. So immediately we're going to know, hopefully, that 10,000 is going to be our activity level that we're going to use. And from this, we can determine what our predetermined overhead rate is. And it is $24 per machine hour. Okay? So let's keep going here. It says actual overhead costs incurred were 249,280. Actual direct labor hours were 41,000, and actual machine hours were 11,000. They want to know what is the total amount applied to the plant-wide overhead account for the year for Carlson. Okay, so if we look at our choices here, we've got the first one is the actual amount. Well, we're using normal cost, so applied overhead is going to be different than actual overhead. So A is going to be wrong. 240,000 in choice C is just what they estimated the overhead cost. So it's going to come down to B or D. All right. So we took the $240,000 here and divided it by 10,000 to come up with our predetermined overhead rate. Now we actually have to apply that rate times the number of machine hours. And if we do that, we come up with $264,000. And that is, in fact, going to be our answer. Let's see here. I might want to skip around just a little bit. We have, so let's see here. We've done those two questions. And before we move on to that, to the next question, we applied overhead of $264,000. Our actual overhead was $249,280. So we would say that we have over applied overhead in this situation to the tune of about $14,720. $14,720 is the 264 minus this figure here. Okay, so let's go up here. Let me get rid of this calculator and answer a couple more questions here. It says here, if actual overhead is greater than applied overhead, the variance is called underapplied overhead. So in our example below, we applied 264 and actual was 249,280. So we said that we over applied it because the applied amount was greater than the actual amount. This is different. If actual overhead is greater than applied overhead, the variance keyword is called underapplied overhead, making this an absolutely true statement. Okay. Now we had some of this information in the PowerPoint video about variances, and we're not really quite, I guess we can go ahead and cover this right now. It says, if the overhead variance is immaterial versus material. Immaterial simply means not that big a deal. Material means, yeah, we got to worry about it. It is allocated among the ending balances of work in process, finished goods, and cost of goods sold. Okay? And this is a false statement. So let me tell you how we actually do this. If the variance is immaterial, we apply everything to cost of goods sold. And it does not matter whether it is underapplied overhead or overapplied. If overhead is underapplied, then cost of goods sold is debited to make it go up because we didn't apply enough expense to the items that were sold. And so if it's an immaterial amount, go ahead and we hit cost of goods sold for the full amount. If, however, and if it's overapplied, that means that cost of goods sold has incurred too much expense, and we're going to take it away. Okay, now if the variance is material, that is when we are going to allocate the balances between work in process, finished goods, and cost of goods sold. And so if we think about this, let's say that we had a material variance that was underapplied. Cost of goods sold would go up by 1/3, and cost of goods sold is an expense. Expenses have a normal debit balance. Work in process is an inventory asset, as is finished goods. Assets have a normal debit balance. So in the event of underapplied overhead that is material, we would have cost of goods sold, work in process, finished goods all going up. Okay, and if we had a material over applied balance, cost of goods sold would be reduced, work in process would go down, and finished goods would go down as well. All right, so let's look at another question here. It says, at the beginning of the year, Forest Corporation estimates overhead will be $175,000. This is their estimate. If actual overhead for the year is $165,000 and applied overhead is $120,000, how should the variance be reconciled? So let's see here now. We had actual $165,000. $165K. Applied is $120K. So we clearly have a situation here of underapplied overhead. So let's look at our choices. Cost of goods sold be increased by $10,000. They're trying to trick you there. Cost of goods sold should be increased by $45,000. Cost of goods sold should be decreased by $10,000 and decreased by $45,000. All right. So if we applied $120,000 to the manufacturing process, but we should have applied $160,000, the best answer here, I want you to stay with me here. The best answer we have here is B. Okay, that is the best answer because cost of goods sold must go up. It must go up. So in this case, what we would do, I'm actually going to, actually, let me just bring a piece of paper over here real quick. In this case, we have underapplied overhead of $45,000. Okay. But I want you to notice something, a couple things. If we were to put a percentage on this, 45 divided by the actual amount of 165, which is going to give us, let's see here. What did I do here? 45 divided by 165 in thousands is over 27% variance. This is likely to be a material figure for a company. The $45,000 is neither material or immaterial. Okay? But the fact that it is underapplied by $45,000 on such a small figure probably makes this material. But based on the question, what we would have is if we increase cost of goods sold by $45,000, we would have a debit to cost of goods sold for $45,000. We would have a credit to the applied overhead account or factory overhead, whatever you want. Doesn't matter. Same thing. For $45,000. I would argue that in this case that the variance is probably material, so we should probably go cost of goods sold, work in process, and finished goods. Okay. And we're going to debit each of these for $15,000. $15,000 is, if we take $45,000 and divide by 3 accounts, we're going to get $15,000. Okay, 3 will go into $45,000, 15,000 times. and then applied overhead would still be credit for 45,000. Okay, so that's what we're kind of looking at here with this example. Okay, all right, I think I want to skip this next little true-false question, and let's close this video out, and then we'll get another one going.